All right, here's another episode of The Federal Church Presents Better Than Bloomberg. Another good note from Zero Hedge here. Titled Pause, Goldman no longer expects Fed to hike in March due to stress in the banking system. It's an understatement again. Earlier we said that the Fed Treasury's new alphabet soup bailout facility, BTFP, by the fucking pivot, it confirms what we have been saying for months. It's just a matter of time before the Fed's rate hikes cause a credit event and force the Fed to pivot. A little bit more than a credit event, it's a systematic failure caused by dipshits. Incidentally, something Michael Hartnett also said in November. Of course, before a Fed pivot, we need to go through a brief pause period. And moments ago, Goldman, which was dead wrong on its call for transitory inflation all of 2021. Yeah, there's nothing transitory about that. He printed trillions of dollars. And which for much of 2022 and early 23 claimed that the Fed will keep hiking rates higher for longer, just admitted it was wrong again and expecting more hikes. Responded to a rhetorical question from yesterday in which we asked if the Fed's going to keep hiking as the government backstops banks on the verge of failure due to high rates. Yeah, it's interesting. There's a lot of banks failing now. Saying that the Fed is done. Below we excerpt from a note just published by Goldman's chief economist and former Uber hawkish preacher, Jan Hatzius, who just threw in the towel on more rate hikes. Expect the rest of Wall Street to follow in the next few hours. The Treasury, Federal Reserve, and FDIC made two major policy announcements intended to stabilize the banking system in response to recent bank failures and the risk of continued deposit outflows. We expect these measures to provide substantial liquidity to banks facing deposit outflows to improve confidence among investors. In light of recent stress in the banking system, we no longer expect the FOMC to deliver a rate hike at its March 22 meeting, with considerable uncertainty about the path beyond March. First, Hatzius looks at the liability side of the bank bailout and lays out the two major policy announcements which are meant to stabilize the bank run gripping small banks as follows. More details in the full note. The FDIC has used a systemic risk exception, SRE, to protect uninsured depositors in two bank resolutions. Again, those are two banks. You'll have a lot more than two banks in trouble. In both cases, the costs not covered by the bank's assets would be funded out of the FDIC's Deposit Insurance Fund, which had a $125 billion balance for 2022. And this is the great part where they don't know how to count. So, their Deposit Insurance Fund has $125 billion, and they need several trillion. And guess who gets to pay for that? You, and inflation. The SRE waives the requirement that FDIC resolution uses the method that is least costly to the DIF. Here, an interesting tangent. The bank cautions that it is an open question is whether the FDIC would continue to address other institutions in the same manner if they are of smaller size than the two banks in question. Well, obviously not. We are confident depositors will stick around in their small regional banks eager to find it. Yeah, you'd have to be retarded to do that. Or maybe not. The Fed and Treasury also announced the Bank Term Funding Program, by the fucking pivot, which would provide advances of up to 1 year to any federally insured bank that is eligible for discount window access, in return for eligible collateral, generally Treasuries and agency securities. Key aspect of the facility is that the Fed would value collateral at par, not the standard haircut the Fed applies in their other programs. This will allow banks to fund potential deposit outflows without crystallizing losses on depreciated securities. The loans are made with recourse beyond the pledged collateral to the eligible borrower, suggesting that the par valuation of the collateral would only become relevant if the borrowing institution lacks sufficient assets to repay the loan. The facility is backstopped with $25 billion from the Treasury Exchange Stabilization Fund, which has a net balance of $38 billion, and is thus woefully insufficient, something we discussed earlier. Like I said, it's idiots who cannot count or reason. But, yeah, again, the rate checks they can't cash. We also discussed that both of these steps are meant to increase confidence among depositors, and according to Hatzius, they are likely to do so. Probably not. We disagree. Even though they stop short of an FDIC guarantee of uninsured accounts as was implemented in 2008, the Dodd-Frank Act limits the FDIC's authority to provide guarantees by requiring congressional passage of a joint resolution of approval, which is only marginally easier than passing a new legislation. Given the actions announced today, we do not expect near-term actions in Congress to provide guarantees. What matters most is how today's bailout impacts the Fed's monetary policy. The answer: the hikes are over. In light of the stress in the banking system, we no longer expect the FOMC to deliver a rate hike in its next meeting, March 22nd, versus our previous expectation of a 25 basis point hike. While the bank has left unchanged its expectation that the FOMC will deliver 25 basis point hikes in May, June, and July, and now expect a 5.25% to 5.5% terminal rate, sees considerable uncertainty about that path. No, they're probably done. And you get to die in inflation. Translation: if the Fed fails to contain the bank run with today's action, what follows pause is pivot, something which the market is clearly pricing in today, as is Goldman. Iqbal did an interview on CNBC Asia today. He pointed out that the net worth of the U.S. Federal Reserve is negative $1.1 trillion due to essentially the same funding investing mismatch that took down SVB. So the only way for the Fed to backstop the system is to print money, and you get inflation. The news of Goldman's capitulation sent two-year yields crashing as much as 25 basis points, and the two-year was last seen as at 4.725, down from the 5.06 on Wednesday, crushing countless Treasury shorts, which is the funny part. Damned if they do, damned if they don't. And all the typical retard gets is inflation.